Physical Gold Fund presents the Gold Chronicles with Jim Rickards and Alex Stanczyk. Insights and analysis about economics, geopolitics, global finance, and gold.
Hello, this is Alex Stanczyk, and welcome back to another podcast for the Gold Chronicles. I have with me today Mr. Jim Rickards. Hello, Jim.
Alex, how are you?
Excellent. Thank you very much. We covered quite a few topics on our last podcast, which includes the risk in cryptocurrencies. We talked a little bit about the G20. We talked about Syria, talked about North Korea. On the North Korea topic, you've been saying for several months now that at some point the U.S. will go to war with North Korea to eliminate the risk that Kim Jong-un might actually nuke a U.S. city. Now, you even mentioned it live on Bloomberg at one point in the last few weeks. The staff there was pretty skeptical of the idea. However, an hour later, North Korea test-fired its first ICBM.
That was one of those amazing coincidences. I wouldn't have said one thing differently if I had known about the test in advance, which of course I didn't. But if whether it was happening or not, I wouldn't have said one thing differently. But they say it's good to be smart and better to be lucky, and sometimes things converge in a way that plays out. But yeah, I mean, it's a serious subject. But literally, I was on the air live with it was Bloomberg Asia. Interestingly, so Bloomberg has a 24-hour cycle. They don't have separate networks for their different regions. They just keep going. So it was 7:00 at night where I was actually in Montreal, 7 a.m. in Hong Kong and Singapore. So we were live on the air to I always say 2 billion people in Asia, so big potential audience, and that's exactly what we said. And the was a great interviewer. So, but I always say it's not the anchor's job to make me look good. That's my job. They're there to kind of hold your feet to the fire. And we had a co-host, and there was a fair amount of skepticism. But then I said I was very categorical about the march to war. We can talk more about that. And then literally minutes later, the news breaks that they just fired an ICBM. People weren't sure it was an ICBM when it went off. It looked like one. Then subsequently, that was verified by a number of sources. So certainly not a good development. What was interesting about that dialogue, Alex, and when I do these interviews, including our podcast, I'll put them out on Twitter, try to expand the audience a little bit. But I can see some, not all of the clicks. Bloomberg will obviously see more than I do. But that interview got more clicks than anything I've ever done outside of a couple of things that just kind of went super viral. But normally, if you get 1,000 or so views, that's pretty good interest. And this one sort of went off the charts, had over 6,000 views in 24 hours, so which is a lot for a TV interview. So that definitely got a lot of attention. But what was interesting, the point I was going to make, is that my co-host, very well established, reputable money manager, he was sort of disparaging gold. I was taking the pro-gold side. And then I went into the thing about North Korea. He said, well, if we're going to war with North Korea, you would definitely want to own gold, as if we weren't going to war, which, again, not a amusing exchange, not an amusing topic, unfortunately. But my point is, well, we're going to war. But it was a really good example of the cognitive dissonance or the denial of and the complacency, for want of a better word, of professional money managers. Like, oh yeah, if we're going to go to war with North Korea, I'd load up on gold. It's like, well, we are. It's happening. It's happening in front of your eyes. You can see it with the 6 months to 1 year lead time. So why don't you get some gold now, an attractive entry point? What are you waiting for? And the answer is they always wait until the first shot is fired, and then gold will be who knows what, $500 an ounce higher, $1,000 an ounce higher, and then they'll run out and buy some, at $1,375, $1,400 an ounce, when you can back up the truck right now and buy it for $1,240. So I never understand it, but it is what it is.
Yeah, pretty typical. For our listeners, if you haven't heard our previous two podcasts, we talk about the North Korea situation in depth. I recommend you go check them out, as well as the last one we just did. We talked quite a bit about the risks in cryptocurrencies, which I think people are starting to explore further. For today's topics, we're going to begin with a few thoughts on physical gold. We're going to discuss a little bit about the U.S. economy. what the Fed is watching in terms of its metrics, Fed policy is in terms of easing or tightening, and we're going to wrap up a little bit with some discussion on a little known problem in the Chinese financial system, or I should say Chinese financial markets. So beginning with physical gold, I recently just got back from a family vacation. We spent some time panning for gold in the Black Hills of South Dakota. And Jim, as you well know, panning for gold is a labor-intensive process. Our little group of 7 people, we spent about 4 hours moving earth. And what that means is we would dig these buckets of earth out of these massive tailings piles that was left over from the gold excavation operations and the gold rush back in the 1870s. So a tailings pile is basically just leftover dirt that they sort of sifted through looking for gold. But the thing was, they were using these screens to find the gold that had these huge holes in them. And back then, they expected to find gold nuggets in much larger size than we find today. But this tailings pile made up the entire side of the riverbed we were on. And even with all of the time and energy we expended, again, there were 7 of us, and we worked for 4 hours doing this, we ended up with less than a gram of gold. And some of this reflects the concept of what's called high grading, which basically means like all of the super high ore deposits in history that we found mostly have already been discovered. I mean, everything that we're doing in mining operations today, we're talking large-scale mining. It's not uncommon for a large-scale operation to require a ton of earth moved to find just 1 or 1.5 grams of gold. So the point that I'm trying to make with all of that is that gold is really stored energy. The energy cost of extracting gold from the earth is now and has always been considerable. I contend that along with physics, these are the 2 primary reasons that gold retains its purchasing power over thousands of years. Jim, you do a bit of panning yourself in your top secret personal location. I'm not going to ask you to divulge where that's at, but tell me a little bit about your experiences there and why gold's physical properties make it ideal for storing value over millennia.
Well, thanks, Alex. And I do a little bit. I should make it clear that I do it for fun and teach my grandchildren a little bit about where gold actually comes from and how scarce it is. So we do it as a recreational thing. I'm not trying to pay my property taxes with my gold output. You at least had the benefit of tailings, where there was some reason to believe that there was some gold around. I'm panning in an area where there is gold. Certainly not in commercially viable quantities, and it's also a very environmentally sensitive place, a very green place, which is a good thing. It's unimaginable to me that anyone could ever get a permit to open a mine. But there are old mines from the 1850s in my vicinity, and there is gold in them. There are hills, as they like to say. In fact. This area was affected by Hurricane Irene in 2011, and there was a bit of a gold rush. People were buying gold pans from the local stores, and believe it or not, running down to parking lots of shopping centers because the earth had literally been stripped off the face of the surrounding area, and it kind of drained into these lower lying areas, and there were just mud piles and water caches and so forth. And they were panning for gold in these parking lots and finding some. So there is gold there. I find it. A gram would be a lot to me. If we found a couple flakes, that would be good. But we do it for fun. But it does make a point, the point you were making, which is this is a known gold mining area, at least back in the 19th century, and it is extremely scarce. And I have visited recently commercial gold mining operations, up in northern Quebec, real gold mines with real development and a lot of drilling going on and equipment moving in. So kind of the real deal. But even there, you're exactly right. It takes a ton of ore, rock and earth and so forth to maybe get a gram if you're lucky. So and that would actually be quite high. It's usually measured in fractions of a gram. So that's how scarce it is. And it would be one thing if you could say, okay, well, I'll get a gram of gold per ton of ore. If you could do that any place you dug up, but you can. I mean, what I'm talking about, as you say, is a high grade location. Those locations are few and far between and seem to be getting more scarce. The other point I would make about gold mining output is that we're talking about very long lead times. Now, what happened, of course, we all know that gold had a magnificent run, one of the great bull markets in history from 1999 to 2011. It went up from about $200, I'll use round numbers, about $200 an ounce, maybe $199 an ounce at the low, to almost $1,900 an ounce. So you're looking at 1,000% gains, 10 times your money in a relatively short period of time. Then it had a major correction, came down about 50%, which is interesting. I think I've said in past podcasts, I mentioned my conversation with Jim Rogers, one of the great traders, period, but particularly one of the great commodity traders of all time, co-founder of the Quantum Fund, along with his partner at the time, George Soros. And Jim told me he's bullish on gold. He owns gold. He holds gold. But he's never seen a long-term bull market that didn't have a 50% correction along the way. He said that's just the way it is. So you get to 1900, gold back down, the low, the interim low or the cycle low was 1050. That was just over a 50% correction if you use 200 as your baseline, as your starting point. And it's been going up since then. It's up over 20% since then. So it looks like that is behind us, and we're on to bigger and better things. But here's my point. So 2011, 2010, 2011, you can only imagine the gold rush fever that was going on, not just in Canada, but around the world. And people were, investing. Capital was easy to raise. A lot of mines were opening up, et cetera. But then a lot of that was priced at, $1,300, $1,400 an ounce, or not really feasible when gold went down below 1,100. So you can well imagine the sort of gold fever that was going on, not just in Canada, but also around the world, when gold was soaring up to $1,900 an ounce. And if your production costs were, $1,100, $1,200, $1,300 an ounce, you could get financing, and you could bring marginal properties back into production, et cetera. Well, when gold went down, certainly to 1,300 by April 2013, then even lower by 2015, those mines were suddenly non-economic. There were a lot of bankruptcies. A lot of projects were called off. Projects were halted in midstream. Other projects went bankrupt, et cetera. And then you just had no, or at least very little, exploration and mining going on in 2013, 2014, 2015 as the price was kind of treading water. What's happened now with the price back up in 1250 and a good upward trend, we'll talk about that in a minute, is that the mining fever is picking up again. But you can't just pick up where you left off. It takes, if you're talking about a greenfield, which is you have an attractive opportunity, you get the mining rights or you lease it, and you start exploring, you start drilling, you do your feasibility studies, you get your financing started. That takes 5 to 7 years before you can bring ounces onto the market. Now, some opportunities are the time horizon shorter than that, because you're literally maybe stepping into the shoes of somebody who went bankrupt at a much lower price point, and you kind of pick up where they left off. So, and there's some mines that were never shut down. But as far as new production, we're in a trough right now. It's going to take years to get production up close to where it was in terms of capacity, if you even could. So it's we all know the demand is sky high. We see that in Russia and China, India, and elsewhere. Supply is tight. You and I have been around the world meeting with, whether it's refiners, miners, vault operators, dealers, et cetera. You hear the same story everywhere. It's amazing. It's really, really hard to fulfill orders, get your hands on gold, et cetera. So the technical setup on the physical side could not be better. Of course, we have our old friend, the COMEX, and anyone that can sell 60 tons of paper gold with a phone call to a broker with no actual gold involved. Obviously, you've got that's occasionally a headwind, but that will fade in time.
Yep, totally agree. So to wrap up our gold commentary, I'd just like to make a quick observation in that I've noted sort of a continual shift in the views of institutional money managers when it comes to what they're allocating to, and that is when they're evaluating the risk in the ability to get liquidity on their assets. it's starting to become a big concern. This makes sense considering the fact that very little has been learned from the past couple of previous crises. I mean, I was just recently looking at your most recent book, Jim, and you were talking about this concept that Wall Street is basically still clinging to the notion that net exposure is what matters, when gross exposure is where the risk really lies, and Wall Street hasn't come around to this view yet. So, just for any financial professionals, money managers who are listening to this podcast, if you're conducting due diligence on gold funds, one area that I would encourage you to look specifically into is how those funds are buying and selling their gold. That's the Achilles heel. And I think you're going to find that they all do it through banks, which is, in our opinion, a big mistake.
Well, they either do it through banks, which leaves you very vulnerable, or they're buying paper gold and expecting to be able to convert it to physical gold. You know, the big gold banks, as you know, Alex, are the members of the London Bullion Market Association. There aren't that many. I don't know the exact number. It's 7 or 8, but they're familiar names. You know, Goldman Sachs, HSBC, and a few others. But when they sell gold, and again, you have to read the contracts carefully, they do it on what's called an unallocated basis, which means all you really have is paper price exposure. They don't have the actual gold. They might have, 1 ton of gold, and they sell it 20 times over. So they're short 20 tons of paper gold, backed up by 1 ton of physical gold. Now, what happens if the longs, the holders of the 20 tons of physical gold, all show up at the same day and say, excuse me, I'd like to convert my unallocated to allocated, and I'd like to take physical delivery, and I'm sending my Brinks truck, and they'll be there in 15 minutes. Well, there's no way that they can satisfy those deliveries. There's no way. What they would do is basically terminate those contracts, send you a check for the price differential. So, yeah, you would get your paper profit up to that point, but that would only happen. See, this is the conditional correlation that Wall Street does not seem to understand, or at least does not want to understand. The world in which the holders of the 20 tons of paper gold all called up the same day to take physical delivery, that's a world where gold's going up, $200, $500 an ounce, per day. Stocks and other paper assets are crashing. There's blood in the streets, as they say. There's a panic. It's when you most want your gold is when you will least be able to get it if you don't already have it. And that's why I've always encouraged those who want exposure to gold to have physical gold in safe non-bank storage. You don't have to worry about delivery. You don't have to worry about fine print and contracts. You've got your gold. Obviously, make sure you're dealing with a reputable fund or provider, or a fund that's backed up 100% by physical gold with no delay. Some of these ETFs, by the way, I'm not saying there's anything dishonest about any of this. What I'm saying is that people don't read the contracts, or if they do, they assume that they can convert when the time comes, and they'll find out the hard way they can't. But that said, some of these ETFs, they take you buy a share of an ETF. That's a secondary market transaction. You're buying the GLD share on the New York Stock Exchange. You're not buying gold. You're buying a share, number one. And when the seller sells to a buyer, that has no impact on the amount of gold in the ETF itself. That only happens when one of these authorized dealers chooses to issue new shares, and then they have to buy gold, deliver it, then they get some new shares. So they can expand the floating supply of shares, if you will. But there are leads and lags in that process. They can issue the shares, and then you can take up to 28 days or so to deliver the physical gold. So the point being, there are, whether it's the ability to terminate a contract on either a force majeure clause or an adverse, material adverse change clause, the ability to delay acquisition of physical gold, the possibility of closing banks, the possibility of futures exchanges ordering and trading for liquidation only. There's just a whole long list of things that can go wrong, and none of them are a substitute for physical gold. By the way, going back to my Bloomberg interview we talked about earlier, Alex, when I was on with this money manager, it was sort of supposed to be one of these pro-gold, anti-gold debates, and he was against gold and I was for it. But it turned out, the more we talked it through, he said, well, we're not totally anti-gold. We allocate from time to time. We're in and out of it the way we're in and out of other things. And, occasionally we'll take up to a 5% allocation. And I said, well, that's interesting because I've never recommended more than a 10% allocation. I've said put 10% of your investable assets in physical gold, not 50%, not 100%, but 10%. So I said, look, if you're occasionally a 5% guy and I'm a 10% guy, we're actually not that far apart. This is a little bit of a phony debate because we both see a role for gold in portfolios. But here's the point. Institutional exposure is 1%. So whether you're with this money manager who occasionally did 5 or whether you're with me and I recommend 10, they're both a far cry from 1. And if the world of institutional investing even moved from 1 to 3 or 1 to 2, forget 5 or 10%, there's not enough gold in the world at these prices to satisfy that demand.
Yep, totally agree. And, just kind of circling back around to the risk part of clearing gold through banks. My perspective as a manager of a physical gold fund is that if I'm a gold fund that has gold assets, and if there are investors that need liquidity and they want to sell gold assets, to me the biggest risk is if their prime broker is a bank. That's no different to me than what just happened in China recently with their stock markets melting down, or what happened in the 2008 global financial crisis. If I was a hedge fund and my primary dealer was a bank, and that bank was frozen up or locked up or unable to trade for whatever reason, I'm basically frozen out of the market. And that's in my view, a very bad place to be. So moving on, next topic.
That's exactly what we've seen. Yeah.
No, go ahead, Jim.
Oh, I was just going to say, we've seen that. Of course, Lehman Brothers was the most famous example, filed for bankruptcy in 2015, 2008, and there were billions of dollars of frozen accounts where the accounts were fully paid up, fully margined. Those securities or instruments or physical gold, whatever it was owned by the client. It was really just in safekeeping at the broker, but those accounts were frozen until there's some court proceeding, et cetera. And then, of course, we saw that with MF Global as well. So these things do happen in the real world.
Yeah, I very much agree. Okay, so next topic, slowing economy. So contrary to optimistic thoughts, there's still a strong concern that the economy, I'm talking globally really, isn't getting better overall. The average person and sovereign governments as well are continually going farther into debt right now in order to make ends meet. The U.S. national debt, as you well know, is approaching the 20 trillion mark with a T. Who would have ever thought that would happen? And other countries are continuing to pile on the debt as well. So I think the compound annual growth rate in global debt over the last 15 years is around 6%. Jim, what are your thoughts about whether the economy is slowing or strengthening in the short to medium term?
Well, Alex, the evidence is very good that the economy is slowing. The best thing you can say about the economy is it's weak. The worst thing you can say is that we're on the edge of a recession and may actually be in a recession before the end of the year. This was a completely predictable consequence of the Fed's blunders by raising interest rates in a weak environment. The Fed is always in the process of making a mistake. It's just they keep making different mistakes at different times. So let me unpack that a little bit and kind of talk about what's going on. And I think in past podcasts we've talked about my basic Fed model, my modal forecast for Fed activity, and I won't go into that in great detail because we have done it before for the listeners. But just to give you the short version of it, the Fed is on track to raise interest rates 4 times a year from now until the middle of 2019. So that would be March, June, September, December, 25 basis points each time, times 4, 1% a year through the middle of 2019 to get interest rates up to around 3.25%, which they would consider normalized. That would be a normal interest rate environment for this late in the business cycle. Now, however, that path is subject to 3 pause factors. So Yeah, they're going to raise 4 times a year, but there are 3 reasons why they wouldn't raise, 3 pause factors. But they're very specific. One is if you see job creation dry up, so it's below 75,000 a month, not 150 or 100 or even 90, but below 75,000 a month, that might cause them to pause. The second factor is strong disinflation, moving away from the Fed's 2% inflation target. And the third factor would be a disorderly stock market decline. And I emphasize the word disorderly. If the stock market went down 10% over 6 months, 2,000 Dow points or 200 points in the S&P, the Fed could care less. But if it went down 10% in 2 weeks, they would care, and that would cause them to pause. So that's the difference between disorderly and orderly. It just happens in a very compressed period of time. So if you see job creation dry up, strong disinflation, or a disorderly stock market decline, then the Fed will not raise rates. In other words, they will pause. If you don't see any of those 3 things, they're going to raise rates. So this is the easiest Fed I've ever seen to forecast. It's actually very straightforward. Why more people don't get it, why Wall Street doesn't get it, and they get all spun up over, some regional reserve bank president like Jim Bullard making a speech or something. I know Bullard is a nice guy, but his speech is irrelevant to monetary policy. I don't understand, but I just gave you the model to forecast Fed policy. Now, right now, and for some time, I said this a few months ago, but I'll repeat it for the listeners, the Fed is not going to raise rates in September. By the way, it's a July meeting coming up. They're certainly not going to raise in July. There was never any significant chance of that, but they're not going to raise rates in September. They're not going to raise rates on November 1st. That's their next meeting. December, I would put it way below 50%. If I had to call it right now, I would say they're not going to raise rates in December. They're done raising rates for the year. But, I'll update my December forecast as we go along. But right now, it's very clear that they're not going to raise rates in September. So I just said they were going to raise them, March, June, September, December. Now I'm saying they're not going to raise in December. Why is that? Which one of the pause factors applies? The answer is disinflation. It's not job creation. Job creation is still strong. Okay, over the past year and a half, it's trended down from way over 200,000 to down closer in the low 100,000 range, with a lot of volatility in there. But that's still good enough. The stock market is reaching new highs every day. So that's not a reason for the Fed to pause. But the reason is disinflation, the second one of the 3 pause factors. Where do we see that? Well, I said the Fed has a 2% inflation target, but there are dozens of inflation measures. There's CPI, PPI, PCE, deflator, core, non-core, trim mean. I mean, without getting too technical on all this, there's just lots and lots of ways to measure inflation. The one the Fed uses, and this is the one you have to watch if you're trying to forecast policy, is core PCE. It's personal consumption expenditure deflator year over year. So core PCE deflator year over year, not month over month, quarter over quarter, not non-core, et cetera. Core PC deflator year over year. That's the one they watch. They want that to be 2%. Now, here's the time series of the data. In February, it was 1.8%. So the Fed's looking at that saying, see, we told you it's going to 2%. In March, it came down to 1.6. In April, it came down to 1.5. In May, it was 1.4. We don't have the June data yet. The June data won't be out until the first week of August. But based on some other data from some other inflation metrics, not the ones the Fed bases policy on, but important ones nonetheless, in PPI and CPI, both of which showed downward trends. They're at higher levels. They're running hotter than PCE core year over year, but they are showing a downward trend. So based on that data, every reason to think that the PCE core year over year will be either at best 1.4, maybe even 1.3, maybe lower. That's a big deal. That is moving away from the Fed's 2% goal, wrong direction. It's moving very strongly. And most important of all, it's moving persistently. Now, what was Janet Yellen saying about that in March, April, May? I mean, I always remind readers, I don't have secret data. We're all looking at the same data. The only thing that separates us are our models and our analytical tools, and maybe a little just kind of different ways of looking at things. But Yellen's looking at the same data. But what was she saying in March and April and even May when this was coming down? She was using the word transitory, transitory. Well, yeah, I see it, but I don't really believe it. It's not going to persist. They're temporary factors, et cetera. One time it's oil. Well, oil is not part of the core. It's part of the overall index. It's not part of the core index. But If oil is going down, it does have ripple effects in other parts of the economy. So there might be reason to believe that that's, if you think oil prices are going back up, which I don't, that might be a reason to call it transitory, but that has persisted. There's a price war in telecommunications carriers, your cell phone carriers, T-Mobile, Sprint, AT&T, whoever uses a price war going on there. She refers to that as transitory. I don't know if it's transitory or not, but I think she has the Gilda Radner problem. Remember, back in the day, Rosanna from Saturday Night Live, her punchline was, "It's always something." And that's Yellen's problem. She can look at one factor and say it's transitory, but it's always something. There's always something coming along. Could be healthcare, et cetera. So this is persistent. And she threw in the towel recently in her Humphrey Hawkins testimony to the House of Representatives a week ago Wednesday. She acknowledged, she said, it might not be transitory or worse to that effect. She didn't quite come out and go full Monty and say, oh no, it's moving in the wrong direction. We have a problem. Houston, we have a problem. She didn't say that in so many words, but she was as explicit as she ever gets about the fact that this is now a problem. So that, boom, hit the pause button and see what happens. Now, interestingly, the Fed doesn't move on a dime. I just gave you 4 data points in February, March, April, May, PCE core that would be very bad for the Fed. So you say, well, okay, so the July number, the June number is going to come out in early August. What if it goes up? What if it goes up to, 1.6? That will not be enough to get them to raise rates in September. And the reason is it takes a long time to get Yellen to turn, but it takes just as long to get her to turn back. In other words, she's now flicked the switch. She's in, disinflation is a problem. We need to pause. She won't reverse that based on one data point. Now, again, if she sees, June, July, August, and is trending, then yeah, okay, maybe she's back on track for a December rate hike. We'll see. But as of now, September is completely off the table. And by the way, I said that a while ago. That's now, I see a lot of economic analysis have come around to that conclusion. But I know we told our listeners that even in the last podcast a month ago. So, but here's the point. This is a reaction to the fact that they had 4 rate hikes. They raised them in December 2015, December 2016, March 2017, and June 2017. They put 4 rate hikes on the table. And I would argue strongly that they began the tightening in May 2013. Now, the so-called liftoff, the first rate hike, was December 2015. So, like, well, Jim, what are you talking about? What do you mean they started in May 2013? That was 2 years before the liftoff. Well, the answer is that there are a lot of ways to tighten. You can do it with forward guidance. You can do it with tapering. And that's what they did. May 2013 was when Bernanke gave the famous taper talk, and we had practically an emerging markets currency and stock market meltdown. And then in December 2013, they started the taper. That persisted through through November 2014. In March 2015, Janet Yellen removed the last bit of forward guidance. They had been including the word patient in their statement, meaning we're going to be patient about raising rates, which means we're not going to raise rates until we give you a heads up. And they took that out, and that was the heads up. And then they didn't actually raise them until December 2015. But that whole sequence of warning about taper, starting the taper, seeing through the taper, removing forward guidance, those were all tightening moves. I remember people saying, tapering's not tightening because you're still printing money. Yeah, but if you're printing less money than you were the month before, that's a form of tightening. It's not extreme tightening, but at the margin, if I'm printing $80 billion a month and I go down to $40 billion a month, which is what they did in stages, that's a form of tightening. You can't say that expanding QE is ease, but somehow contracting QE is not tightening. That's just illogical, and it's also not empirically correct. But here's the key, Alex. Our friend Milton Friedman reminds us that monetary policy operates with a lag, and the lag can be 18 months to 2 years. So if you start tightening in small ways in 2013, you start tightening aggressively in 2015 and 2016, you should expect the economy to perhaps go into a recession in late 2017. And here we are, right on time. But of course, the Fed is always the last to know. So they're going to try to undo the damage by pausing, but that is probably not enough. And then they'll have to, if we go into a recession, they'll have to throw the whole show in reverse which means actual rate cuts and getting back down to the zero bound, and then QE4. So this, by the way, is extremely bullish for gold. I know we talked about gold earlier in the podcast. We switched to the Fed, but look, when people talk about gold going up or down, what they're really talking about is the dollar price of gold. I think of gold by weight. I think that's the right way to think about gold. I think gold is money, but for those who think of gold in terms of a dollar price, well, the dollar price of gold is just the reciprocal of the strength of the dollar. So a strong dollar means a lower dollar price for gold. That's what we saw in 2012, 2013. A weak dollar means a higher dollar price for gold. That's what we're starting to see now. Now, the dollar has come off the top, but when the Fed switches to ease along the lines I just described, when we get to September, and they don't hike, and perhaps they offer some forward guidance, and they say, we're not going to hike in December. This will weaken the dollar, and that's very bullish for gold. So my advice to gold investors is you've got a great entry point here. Don't wait till it's back up over 1,300. You might still want to buy then because it'll go even higher in the long run. But you've got a great entry point right now. Very, very good reason to buy gold based on this Fed forecast. If you like, Alex, I'll leave it to you, but it's a little bit technical. But our friend Leo Brainerd, who's also a member of the Board of Governors and voting member of the FOMC, gave a speech a couple days before Yellen's testimony. Yellen testified on July 13th, but Brainerd gave a speech on July 11th, which was absolutely fascinating and indicates that the Fed still doesn't get it.
Yes, and speaking of policy lag and how that affects the value of the U.S. dollar, and as you just mentioned, the U.S. dollar and the U.S. dollar gold price is basically an expression of U.S. dollar buying power. There's sort of a common point of confusion here, considering that central banks have injected something like 15 trillion U.S. dollars of currency into the economy over the last decade. But it really hasn't shown up in price inflation. And the area that we're seeing the inflation is in financial assets. So if you talk to Austrian economists, for example, they will tell you that asset price inflation is actually the precursor to consumer price inflation. So that could still be in the cards. And if we see that will definitely be an expression of the loss of buying power in the U.S. dollar.
I study Austrian economics. I think it has a lot to offer. I don't consider myself an Austrian economist. I consider myself a complexity theorist and a few other branches of science that I bring to capital markets. That's how I understand capital markets. But yeah, the Austrians definitely have a lot to offer, and they would also say that I'm not sure that asset price inflation. I mean, it certainly can be a precursor to consumer price inflation. I wouldn't rule that out. And if they keep going, eventually it will be. But asset price inflation results in bubbles. And if bubbles burst, then you actually have financial panics. And you could have deflation in nominal space, but of course a financial panic would mean a major run to gold. So as a safe haven asset. So people maybe other things would be collapsing, and maybe even consumer prices would be coming down in a recession or a financial panic, which they would. But gold and treasuries would be going up as safe havens. I remind people the greatest period of sustained deflation in American history was the Great Depression from 1929 to 1933. And yet in the Great Depression, gold went up 75% from $20 an ounce to $35 an ounce. And the best performing stock on the New York Stock Exchange was Homestake Mining, which rallied when the market was going down from top to bottom over 80%. So gold is a funny thing because it is money. It can perform very well even in environments when everything else is falling apart.
All right, very good.
Because people want money.
Exactly. Okay, so Jim, we're pretty much out of time. We did have on the agenda for today a certain disturbing trend that's going on in China, but I think we're going to have to leave that for our next podcast. I appreciate you being on with me as always. It's been a great discussion, and I think our listeners are going to very much enjoy it.
Thank you, Alex. Great to be with you.
You have been listening to The Gold Chronicles with Jim Rickards and Alex Stanczyk, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers. Physical Gold Fund presents the Gold Chronicles with Jim Rickards and Alex Stanczyk. Insights and analysis about economics, geopolitics, global finance, and gold.
Hello, this is Alex Stanczyk, and welcome back to another podcast for the Gold Chronicles. I have with me today Mr. Jim Rickards. Hello, Jim.
Alex, how are you?
Excellent. Thank you very much. We covered quite a few topics in our last podcast, which includes the risk in cryptocurrencies. We talked a little bit about the G20. We talked about Syria, talked about North Korea. On the North Korea topic, you've been saying for several months now that at some point the U.S. will go to war with North Korea to eliminate the risk that Kim Jong-un might actually nuke a U.S. city. Now, you even mentioned it live on Bloomberg at one point in the last few weeks. The staff there was pretty skeptical of the idea. However, an hour later, North Korea fired its first ICBM.
That was one of those amazing coincidences. I wouldn't have said one thing differently if I had known about the test in advance, which of course I didn't. But if whether it was happening or not, I wouldn't have said one thing differently. But they say it's good to be smart and better to be lucky, and sometimes things converge in a way that plays out. But yeah, I mean, it's a serious subject. But literally, I was on the air live with it was Bloomberg Asia, interestingly. So Bloomberg has a 24-hour cycle. They don't have separate networks for their different regions. They just keep going. So it was 7:00 at night where I was actually in Montreal, 7 a.m. in Hong Kong and Singapore. So we were live on the air to I always say 2 billion people in Asia, so big potential audience, and that's exactly what we said. And the it was a great interviewer. So, but I always say it's not the anchor's job to make me look good. That's my job. They're there to kind of hold your feet to the fire. And we had a co-host, and there was a fair amount of skepticism. But then I said I was very categorical about the march to war. We can talk more about that. And then literally minutes later, the news breaks that they just fired an ICBM. People weren't sure it was an ICBM when it went off. It looked like one. Then subsequently, that was verified by a number of sources. So certainly not a good development. What was interesting about that dialogue, Alex, and when I do these interviews, including our podcast, I'll put them out on Twitter, try to expand the audience a little bit. But I can see some, not all of the clicks. Bloomberg will obviously see more than I do. But that interview got more clicks than anything I've ever done outside of a couple of things that just kind of went super viral. But normally, if you get 1,000 or so views, that's pretty good interest. And this one sort of went off the charts, had over 6,000 views in 24 hours, so which is a lot for a TV interview. So that definitely got a lot of attention. But what was interesting, the point I was going to make, is that my co-host, very well established, reputable money manager, he was sort of disparaging gold. I was taking the pro-gold side. And then I went into the thing about North Korea. He said, well, if we're going to war with North Korea, you would definitely want to own gold, as if we weren't going to war, which, again, not a amusing exchange, not an amusing topic, unfortunately. But my point is, well, we're going to war. But it was a really good example of the cognitive dissonance or the denial of and the complacency, for want of a better word, of professional money managers. Like, oh yeah, if we're going to go to war with North Korea, I'd load up on gold. It's like, well, we are. It's happening. It's happening in front of your eyes. You can see it with the 6 months to 1 year lead time. So why don't you get some gold now, an attractive entry point? What are you waiting for? And the answer is they always wait until the first shot is fired, and then gold will be who knows what, $500 an ounce higher, $1,000 an ounce higher, and then they'll run out and buy some, at $1,375, $1,400 an ounce, when you can back up the truck right now and buy it for $1,240. So I never understand it, but it is what it is.
Yeah, pretty typical. For our listeners, if you haven't heard our previous two podcasts, we talk about the North Korea situation in depth. I recommend you go check them out, as well as the last one we just did. We talked quite a bit about the risks in cryptocurrencies, which I think people are starting to explore further. For today's topics, we're going to begin with a few thoughts on physical gold. We're going to discuss a little bit about the U.S. economy, what the Fed is watching in terms of its metrics, Fed policy is in terms of easing or tightening, and we're going to wrap up a little bit with some discussion on a little-known problem in the Chinese financial system, or I should say Chinese financial markets. So beginning with physical gold, I recently just got back from a family vacation. We spent some time panning for gold in the Black Hills of South Dakota. And Jim, as you well know, panning for gold is a labor-intensive process. Our little group of Southern people, we spent about 4 hours moving earth. And
50, that was just over a 50% correction if you use 200 as your baseline, as your starting point. And it's been going up since then. It's up over 20% since then. So it looks like that is behind us, and we're on to bigger and better things. But here's my point. So 2011, 2010, 2011, you can only imagine the gold rush fever that was going on, not just in Canada, but around the world. And people were, investing. Capital was easy to raise. A lot of mines were opening up, et cetera. But then a lot of that was priced at, $1,300, $1,400 an ounce, or not really feasible when gold went down below $1,100. So you can well imagine the sort of gold fever that was going on, not just in Canada, but also around the world, when gold was soaring up to $1,900 an ounce. And if your production costs were, $1,100, $1,200, $1,300 an ounce, you could get financing, and you could bring marginal properties back into production, et cetera. Well, when gold went down, certainly to 1,300 by April 2013, and then even lower by 2015, those mines were suddenly non-economic. There were a lot of bankruptcies. A lot of projects were called off. Projects were halted in midstream. Other projects went bankrupt, et cetera. And then you just had no, or at least very little, exploration and mining going on in 2013, 2014, 2015 as the price was kind of treading water. What's happened now with the price back up in 1250 and a good upward trend, we'll talk about that in a minute, is that the mining fever is picking up again. But you can't just pick up where you left off. It takes, if you're talking about a greenfield, which is you have an attractive opportunity, you get the mining rights or you lease it, and you start exploring, you start drilling, you do your feasibility studies, you get your financing started. That takes 5 to 7 years. Before you can bring ounces onto the market. Now, some opportunities are the time horizon shorter than that, because you're literally maybe stepping into the shoes of somebody who went bankrupt at a much lower price point, and you kind of pick up where they left off. So, and there's some mines that were never shut down. But as far as new production, we're in a trough right now. It's going to take years to get production up close to where it was in terms of capacity, if you even could. So it's we all know the demand is sky high. We see that in Russia and China, India, and elsewhere. Supply is tight. You and I have been around the world meeting with whether it's refiners, miners, vault operators, dealers, et cetera. You hear the same story everywhere. It's amazing. It's really, really hard to fulfill orders.
What that means is we would dig these buckets of earth out of these massive tailings piles that was left over from the gold excavation operations and the gold rush back in the 1870s. So a tailings pile is basically just leftover dirt that they sort of sifted through looking for gold. But the thing was, they were using these screens to find the gold that had these huge holes in them. And back then, they expected to find gold nuggets in much larger size than we find today. But this tailings pile made up the entire side of the riverbed we were on. And even with all of the time and energy we expended, again, there were 7 of us, and we worked for 4 hours doing this, we ended up with less than a gram of gold. And some of this reflects the concept of what's called high grading, which basically means like all of the super high ore deposits in history that we found mostly have already been discovered. I mean, everything that we're doing in mining operations today, we're talking large scale mining. It's not uncommon for a large scale operation to require a ton of earth moved to find just 1 or 1.5 grams of gold. So the point that I'm trying to make with all of that is that gold is really stored energy. The energy cost of extracting gold from the earth is now and has always been considerable. I contend that along with physics, these are the two primary reasons that gold retains its purchasing power over thousands of years. Jim, you do a bit of panning yourself in your top secret personal location. I'm not going to ask you to divulge where that's at, but tell me a little bit about your experiences there and why gold's physical properties make it ideal for storing value over millennia.
Well, thanks, Alex. And I do a little bit. I should make it clear that I do it for fun and teach my grandchildren a little bit about where gold actually comes from and how scarce it is. So we do it as a recreational thing. I'm not trying to pay my property taxes with my gold output. You at least had the benefit of tailings, where there was some reason to believe that there was some gold around. I'm panning in an area that where there is gold. Certainly not in commercially viable quantities, and it's also a very environmentally sensitive place, a very green place, which is a good thing. It's unimaginable to me that anyone could ever get a permit to open a mine. But there are old mines from the 1850s in my vicinity, and there is gold in them Dar hills, as they like to say. In fact. This area was affected by Hurricane Irene in 2011, and there was a bit of a gold rush. People were buying gold pans from the local stores, and believe it or not, running down to parking lots of shopping centers because the earth had literally been stripped off the face of the surrounding area, and it kind of drained into these lower lying areas, and there were just mud piles and water caches and so forth. And they were panning for gold in these parking lots and finding some. So there is gold there. I find it a gram would be a lot to me. If we found a couple flakes, that would be good. But we do it for fun. But it does make a point, the point you were making, which is this is a known gold mining area, at least back in the 19th century, and it is extremely scarce. And I have visited recently commercial gold mining operations, up in northern Quebec, real gold mines with real development and a lot of drilling going on and equipment moving in. So kind of the real deal. But even there, you're exactly right. It takes a ton of ore, rock and earth and so forth to maybe get a gram if you're lucky. So and that would actually be quite high. It's usually measured in fractions of a gram. So that's how scarce it is. And it would be one thing if you could say, okay, well, I'll get a gram of gold per ton of ore. If you could do that any place you dug up, but you can't. I mean, what I'm talking about, as you say, is a high grade location. Those locations are few and far between and seem to be getting more scarce. The other point I would make about gold mining output is that we're talking about very long lead times. Now, what happened, of course, we all know that gold had a magnificent run, one of the great bull markets in history from 1999 to 2011. It went up from about $200, I'll use round numbers, about $200 an ounce, maybe $199 an ounce at the low, to almost $1,900 an ounce. So you're looking at 1,000% gains, 10 times your money in a relatively short period of time. Then it had a major correction, came down about 50%, which is interesting. I think I've said in past podcasts, I mentioned my conversation with Jim Rogers, one of the great traders, period, but particularly one of the great commodity traders of all time, co-founder of the Quantum Fund, along with his partner at the time, George Soros. And Jim told me he's bullish on gold. He owns gold. He holds gold. But he's never seen a long-term bull market that didn't have a 50% correction along the way. He said that's just the way it is. So you get to 1900, gold back down. The low, the interim low or the cycle low was 10.